You don't need incredible IQ, insider knowledge, or luck to be successful in investing. Instead, a strong intellectual framework for decision making is required, along with the ability to prevent emotions from ruining decision making. In The Intelligent Investor, Benjamin Graham presents such a framework with logic for controlling emotions. His investment strategy is probably one of the most successful in the last 100 years. The impressive record, not only from Graham himself, but his many students, also cannot be overlooked. The brightest star among them is Warren Buffett, who was the third richest person in the world at the time of this video. Warren Buffett called it the best investment book ever written. In this video I will present the main points that I can think of from this book. 1. Meet Mr. Market. Imagine that you paid him $1,000 to own a part of a business. Every day, Mr. Market will come to your house and give you an opinion on how much he thinks your stock is worth in this company. Aside from that, he will suggest buying your stock or selling another based on that. History proves that Mr. Market's opinion on how much your company's stock is worth can be utter gibberish. For example, back in March 2000, he valued your stock at $2,600. Exactly 1 year later, in March 2001, he valued it at $500. The company's revenue increased by 50% and profit increased by 20% over that same period. Should you let this guy decide the value of your $1,000 stock in this company? Of course not. One of Graham's core principles is that a stock itself is not just a ticker symbol combined with a price tag, it's an ownership in a company. And because Mr. Market is not always rational, the underlying value of the company may differ from the price he is willing to pay for it. In fact, Mr. Market is often overvaluing or undervaluing the stock because he can be overly optimistic or pessimistic. Graham advises investing only if you feel comfortable to hold the stock in the future without letting the price fluctuations affect your judgment. Mr. Market presents a good opportunity to make money because he doesn't force you to strike a deal with him. He just presents you with an opportunity of doing so. If he offers a suitable price, you should be happy to take that offer. It should be remembered that at the time Graham wrote this book, people were much less exposed to the news, forecasts, stock quotes, and so on than we are today. Back in the 1970s, Mr. Market probably came once a day with the morning paper. Today he wants to do business with you every time you open your phone. If you are like me, it happens over 100 times a day. If Mr. Market often visits you, that doesn't mean you should trade with him more than you used to in the 1970s. If he doesn't make a proposal that meets your criteria, ignore him and go on with your day. Insight 2. How to invest as a defensive investor. According to Graham, there are two types of investors: defensive or passive investors and enterprising or aggressive investors. Most people are better suited for the defensive strategy as the time they are willing to dedicate to investing is limited. A defensive investor should invest in a portfolio that combines bonds and stocks. Let's say 50% stocks and 50% bonds. Note that how much you should invest in each asset class depends on your living situation and current differences in average yield of stock versus bonds. You should restore that allocation once or twice a year. If suddenly stocks are 60% of your portfolio and bonds are 40%, sell stocks and buy bonds until 50-50 recovers. Invest a certain amount of capital at regular intervals, for example immediately after receiving a paycheck. This is known as dollar cost averaging and achieves fair average prices for both stocks and bonds. This eliminates a rush of purchases at the wrong time. For the stock component of the portfolio, defensive investors should aim for 1. Diversification of invested companies. 10 to 30 companies should be enough. Also, be careful not to focus too much on a single industry. 2. Your company should be large. By Graham's definition, annual sales should be more than $100 million. Adjusted for inflation, this equates to about $700 million in today's value. 3. Look for companies with conservative funding. Such companies have a so-called current ratio of at least 200%. This means that the current assets that the company owns is at least twice as big as the current liabilities of the company. 4. Dividends should be preferably have been paid out to shareholders for at least the last 20 years. 5. No earning deficit in the last 10 years. 6. The earnings of the company should have grown at least over 33% over the last 10 years. This equates to a conservative annual growth of 2.9%. 7. Don't overpay for assets. The price of the stock should not exceed 1.5 times its net asset value. Net asset value can be calculated by subtracting the liabilities from the company's assets. 8. Don't pay too much for earnings either. Don't let the PE ratio be more than 15 when using the last 12-month earning. An alternative is to invest in index funds that by definition produce returns similar to the market average. If you're happy with an average return on investment, the first 2 insights is all you need. But if you want more than that, you should think about this too. 3. How to invest as an enterprising investor. Because it's very easy for a defensive investor to get the market's average return, winning the market seems easy. You're just spending a little more time investing than this average investor, right? As this logic suggests, becoming an entrepreneurial investor and winning the market is much harder. It takes patience, discipline, and a willingness to learn, and a lot of time. Many professionals and private investors are not suitable for this. It's easier than you think to fall prey to Mr. Market's price quotes. Listen to these 2 next statements from early 2000s at the height of the dot-com bubble. These quotes were said by the chief investment strategists at the 2 largest mutual funds. One said, "It's a new world order. We see people discard all the right companies with the right people with the right visions because their stock price is too high. That is the worst mistake an investor can make." The other said, "Is the stock market riskier today than it was 2 years ago simply because the prices are higher?" The answer is no, but the answer is actually yes. Both statements proved costly for investors who put their money into these funds. Since the profits a business can make is finite, the price an intelligent investor should be willing to pay for these companies should also be finite. Price is a very important factor for an enterprising investor. Just like the market can overvalue companies when they have been growing fast or are glamorous for some other reason, it tends to overvalue the ones with unsatisfactory development. An intelligent investor should therefore try to avoid so-called growth stocks as much as possible. Why? Simply because investment decisions in these types of stocks are based relatively on future returns. And future returns are less reliable than the current valuations of the business. On the other hand, if you find a company whose value is less than its net working capital, you essentially will pay nothing for all the fixed assets, such as buildings, machinery, or goodwill. Net working capital can be calculated by subtracting total liabilities from its assets. In Graham's investment career, such companies proved highly profitable. Unfortunately, we rarely see those types of companies these days, except in bear markets. Luckily, Graham offers another way to find investments for enterprising investors. These criteria are similar to those that defensive investors should use, but are less restrictive. This allows enterprising investors to consider more companies. Please note that there is no limit to the size of the company. There should also be some diversification. But for active investors, the number of companies they own is not fixed. When analyzing a company, entrepreneurial investors should also study its annual financial reports. 4. Claim a margin of safety. There is one risk that cannot really be ruled out, even with careful consideration. That's the risk of getting it wrong. However, you can minimize this risk. To do this, you should insist that there is a margin of safety for any investment you make. As already mentioned, the price and value of a company are not always the same. If the price is up 2/3 of the calculated value, the investor has found a company with a good margin of safety. You wouldn't build a boat that sinks if 31 people boarded it if you know that it will regularly be used to transport 30 people. Also, you shouldn't invest in a stock that you think is worth, say, $31 when the price is currently $30 for it. Your calculation may be wrong. In the first case, the angry and wet group of people may hunt you. In the second case, financial freedom may be delayed for several years. I don't know which situation should be considered worse, so make sure you use a margin of safety. The formulas used in this book can tell you how much your company is worth and if it's worth it. You should buy with a certain margin of safety. Value equals current normal income times 8.5 plus 2.5 times the expected annual growth rate. the growth rate should match the expected annual revenue growth rate over the next 7 to 10 years. According to the September 2018 formula, the values of the top 3 companies in the S&P 500 are. Note that this formula can also be used in reverse to find out how much these companies will need to grow in the next 7 to 10 years for today's stock price to be rational. This year, Amazon is expected to grow 43%, while Apple is expected to grow just 22%. According to the stock price, do you think that makes sense? 5. Risk and reward are not necessarily correlated. According to academic theory, the return that an investor can expect is proportional to the degree of risk he can take. Risk is then measured as the volatility of investment returns. Graham disagrees with this statement. Rather, he argues that the asset price and values are often unrelated. Therefore, the return an investor can expect depends on how much time and effort he puts into finding good deals. The lowest returns are given to defensive investors, while the highest returns are given to enterprising investors who can train their skills and intelligence. Consider this situation. It's 4 o'clock in the morning, and you and your friends were drinking on the streets of Moscow. You decide it's too early to go home and call it a night, so you end up going to the remote parts of the city, in a particularly obscure bar, and a man approaches you. He then asks, "Would you like to play a game?" "Sure, games are fun," replies our bravest and least sober friend. The man puts a revolver on the table, charged with a single bullet. "I'll give you 10,000 if you play Russian roulette." The drunken friend reaches for the gun, but you stop him and tell the man politely, "No thanks, we're good." "I thought so," he replies. "How about 100,000 for 2 shots? Now this story represents an academic method of seeking higher potential rewards for taking higher risks. In the first offer, you receive $10,000 with the risk of having your brain blown out to be 16.7%. The second offer has a reward of $100,000. But the risk of you getting a hole in your head is twice as large, 33.3% this time. Sounds logical, right? But investing in the stock market doesn't have to be this way. Please note that the price and value are not the same thing. If you buy a company for 70 cents on the dollar, the potential rewards are large and the risks are low. Plus, if you can find another business for 50 cents on the dollars, you find a better potential reward. How can any sane person argue that buying a dollar worth of a stock for 50 cents is riskier than buying a dollar worth of a stock for 70 cents? All because the potential rewards are higher.